So we have Joseph Wang and Danielle DiMartino Booth, and it has been an interesting week so far when it comes to the Fed. We saw rates held steady after the June meeting and guided toward only one rate hike for this year for 2024, down from previous expectations for three. Quite the update, folks. Joseph, let's start with you. What's pushing the Fed to be more hawkish right now?
Yeah, it really surprised me actually. I was thinking that the Fed would actually have just two cuts in their dot plot, and they only had one. Now, the Fed seems to be a bit worried that they're going to make the mistake of just being too loose too quickly. So, over the past few couple years, the Fed has made tremendous errors in forecasting inflation. And so I think that's making them a little bit more hesitant. Now, Chair Powell was asked about what he thought would happen if he cut rates once during the conference. And his response was that, well, if we cut rates, well, I think financial conditions would loosen significantly. I think what he's thinking of at that time is in December, when he suggested that, we're going to start cutting rates this year, the market basically went euphoric, pricing in as many as 7 cuts in January. So Chair Powell realizes that the moment he starts to cut, I think things are going to go crazy. So he wants to be careful to delay that as much as possible to make sure that he doesn't cut too prematurely and again make the error of letting inflation get out of hand.
Danielle, let's talk a little bit about what the data showed us. Just before the June meeting ended, headline May CPI came in flat month over month and grew by 3.3% annually. How did that compare with what you were expecting and then what the market was expecting?
At QI Research, we've been looking for a lot of downside in the inflation metrics, given what we're seeing on the household side. We track Bank of America debit and credit card data on a weekly basis very carefully, and we've been seeing discretionary spending really, really take a hit. And the thing about discretionary versus non-discretionary, which is how we parse out the inflation data, is that for what households are spending on essentials, things they absolutely must buy, rent, healthcare, food, gasoline at the gas pump. That inflation's running at 4.7% year over year, a tremendous rate. Everything that's discretionary is running at 0.1%. And if there's something that we've picked up with, whether it's occupancy data that we're seeing, it's that we're seeing major deflationary forces right now in travel, whether it's hotels, rental cars, or airlines. They're all negative numbers on a year over year basis. The PPI came in weak as well. And we're starting to see the vestiges of all of these bankruptcies. We've got record bankruptcies running in the month of June already. We're seeing that filter into initial jobless claims finally, because of course people have a lot less time of severance in 2024 compared to what it was when it was a white collar labor recession in 2023.
So when Fed Chair Jay Powell says he needs to see more good data to get conviction that inflation is moving towards that 2% target, what is he looking for at this point, Joseph? Let's start with you. I thought Danielle's breakdown was fascinating on that discretionary versus non-discretionary piece. What do you think Jay Powell is going to be looking for, Joseph?
Well, as Danielle notes, the economy has definitely been slowing, and that should feed through and see inflation moderate. So Chair Powell was pretty clear that he sees two paths to rate cuts going forward. The first path, of course, is having more confidence that inflation is getting back towards 2%. Now, the Fed's target is not CPI, it's PCE, and PCE most recently printed at 2.7%. It's still above 2%, but a couple years ago it was 7%. So it's getting there. I think what he wants to see is more downward progress on PCE. PCE has been kind of stuck around 2.7% for the past few months, actually. So that, I think, is worrying him a bit. Now, the good news is that today we got PPI data lower than expected, and the latest inflation nowcasts are suggesting that PCE inflation is falling towards 2%. Okay, maybe 2.6, maybe 2.5 the coming months. Not 2%, but it's getting there. So maybe that'll give him more confidence. The other path towards rate cuts is a rise in unemployment. And I actually think we're going to get that. Now, Danielle has been all on top of tracking these employment trends, so I'll let her speak more to that. But one thing to note is that we're just having tremendous amounts of migration, millions and millions of people entering the country. and that's going to put some upward pressure on unemployment. So I think that we get more cuts than one this year.
Danielle, talk to us about those labor market numbers. Unemployment reached 4% in May. The economy gained more jobs nonetheless than expected, north of 270,000 additions. But to Joseph's point, you've been out there, I've been tracking your layoff tracker. Talk to us, what's the Danielle version of what's going on in the labor market? Unpack those numbers for us.
So it's been pretty fascinating to see the depth of the revisions. And actually, Chair Powell stated yesterday for the first time that those non-farm payrolls may be, quote unquote, overstated. So he's recognizing the depth of the revision. We had the Bureau of Labor Statistics had penciled in a positive 640,000 for the 3 months ended September the 30th, 2023. As it turned out, that was a negative 192,000. So I've become pretty friendly with Anna Wang, Bloomberg's chief economist, and she is actually in agreement with me that net job losses began in October of 2023 and will continue going forward. In other words, that the recession is going to be backdated until October of 2023. And what makes us think that there's going to be continued upward momentum, it's the sheer number of closings of businesses, closings of factories, plants. The layoff statistics that we've seen have really been extraordinary, and the bankruptcy cycle has picked up quite a bit of momentum.
Nevertheless, the markets would never seem to be telling us that if we looked at it. Let's take a look at what's been going on. S&P up more than 1%.
They will not. The stock market is the very last to get the memo, and it only starts to decline when the Fed starts to cut, and not until then.
So let's talk about tech. Tech has been on a tear, even with a hawkish Fed. Joseph, when we see that rate cut finally come, DCS will tell you that tech goes even higher. Some of the recession data that you've been talking about, Danielle, may say it goes the other direction. Where are you landing on that?
I think we surge. I think we go higher than anyone ever expects. So the big drivers, I think, of the rally are just the tremendous amounts of deficit spending that's happening, and it's going to happen for the foreseeable future. Listen, if you look at the projections from the Congressional Budget Office, 6% of GDP is going to be spent year after year, basically forever. It's so alarming that the IMF actually has a special section specifically dedicated to the fiscal problems of the United States. Now, I think that's not going to change. And depending on what happens in November, it could get even more severe. So if we have a Trump presidency, man, I think we're off to the races. It could be a very inflationary cycle. So I'm very positive on equities.